from there. Talk to us about the Indian market and its potential at this point.
So US will continue to remain, and not just US, by the way, I'll basically put North America in one category, will continue to remain one of the largest markets for us. Like, more than 65% of the revenue will still continue to come from the US as a market. However, when we launched our products in India in December 2022, right, India really surprised us, right? The traction that we are seeing in India and the consumer love that we are seeing in India is just phenomenal. So essentially, while US will continue to remain the large market for us, India will hopefully contribute between 10 and 15% of our overall revenue by the end of the financial year. In terms of online and offline mix, today we are almost 50-50. But as we scale, right, we really want to meet the customers where they are. And today, for home essentials category, 85% of the customers still shop at a store. So essentially, we will basically see by the end of this year, offline will contribute close to 60 to 65% of our revenue, with today's 50%.
All right, and give us a sense of the kind of insights you're getting from your consumer. Talk to us about how you view each of your markets and how do you customize based on consumer needs and preferences?
Yeah, so essentially, so the good part is essentially like, consumers are very clear like what they want, right? They want plastic-free, tree-free, and they don't want products, right, that is actually going to live in a landfill about 1,000 years. So couple of things that we do is essentially we have on-the-ground marketing teams that actually look at all the consumer trends and what our consumers want. We customize those products according to each market when we launch the product. And essentially that helps us win in the global market, right?
Right.
So, for example, right, the products that we sell in India, right, are very customized to the Indian market. Like we have 4-compartment trays because we know that people actually eat, for example, pav bhaji or idli in that, right? So essentially, there are a lot of product level customization that happens for individual markets that we enter.
All right. Okay, Rahul, thank you so much for joining us on the show today. We're completely out of time and we wish you all the best going forward.
Thanks, Arun. Thank you so much for having me here.
All right, moving on. Adventum Student Living, which is the platform which owns the UniAco, UniCred and UniScholar brands, has raised an additional $5 million led by new and existing investors as a bridge to its proposed Series B round of $20 million. Now, ASL is a unified student lifecycle management platform which assists students in their application to accommodation journey with a digital-first approach. To date, they've helped about 5 lakh students through the platform. Joining me now to talk about the company's plans to scale and more is its founder and CEO, Amit Singh. Amit, welcome on Startup Street and thank you for your time here on CNBC-TV18. If you could start by telling us about this funding that you've announced, why the bridge equity and when do you hope, hi Amit, and when do you hope to conclude this Series B round of $20 million?
So this is called bridge because this 5 million has come in before the rest of 15, but we are in advanced talk with other investors to come on board. These are larger investors, and timing wise also, this is not the time we need the whole of funding to come in. This is primarily the growth funding which we have closed, and this will largely make sure that the revenues we are on track to achieve what we have set for ourselves. But otherwise, yes, we are in advanced talks with other investors to the rest of the money to come in soon.
All right, so soon you're looking to close that, but you want to use these funds to expand your product offerings. What exactly do you mean by that? I mean, you have 3 brands. Will you expand into early career as well, or will you be looking to expand products within these 3 brands?
No, so the focus is going to be primarily to increase the product bouquet within the 3 brands. Just to give you a context, in UniAco, from serving largely one destination country being UK, we now help students in finding accommodation in European countries, primarily your Germany, Spain, Italy. We have also expanded our operations into Australian market. So it's geographical expansion for UniAco, adding more destination countries for UniScholars, which is into counseling business. So we started last year with one destination market being UK. Today we serve most of the destination markets. So largely the strategy or this money is going into expanding into the existing brands rather than expanding the horizon.
So, but will you be looking to expand into newer geographies outside the ones that you're already present in?
Yes, yes.
And what would those geographies be, Amit?
So, like in destination markets, as I said, we were helping students to find right opportunities and courses and their careers in UK. We have expanded into US, Australia, Canada, Germany, New Zealand, Ireland. These are the geographical expansions we have done in Uni Scholars. In UniAco, as I said, we were doing UK, but now we also help students in finding accommodations in Germany, Spain, Canada, Australia. So that's how we have geographically expanded.
You know, overall, the company has had about 300% kind of growth since COVID, but it's also coming on a very low base. Is this kind of growth going to be sustainable? And, you know, what about profitability across your three brands? What is the current burn and when do you hope to achieve that?
Yeah, so the company will be EBITDA positive by CY23, and we are on pretty much on track on that. In terms of opportunity space, it's the way you look at opportunity. We are truly a global company with all three brands present internationally. So for us, if you see the target market is huge. Just to give you a context, Ritu, that globally there are 38 million students in these 6-7 destination markets I'm talking about. And each and every student needs an accommodation. A lot of them, they need counseling, and many of them, they need financing. So with this platform approach, the idea is to, when the student comes into our ecosystem, the idea is to sell them more than one product. And with that, if you add it up, it's a massive target market is what you're looking at. Just to give you a ballpark number, somebody has actually assessed this target market to be upward of $3 trillion. And when I say I'm talking about these 38 million students all put together. Yeah.
All right, that's a pretty large market, but
Yes.
you know, how much of that do you have currently? And I also, you know, out of curiosity, how many students actually stick with the platform for all of the three brands, seeking accommodation, seeking loans? How many use all of your products?
Yeah, so that's very interesting, Ritu. Like this platform we have built over time. We started our journey 3 years back with UniAco. 2 years back, we launched our financing platform, which was UniCreds. And last year, we launched Uni Scholars. And since we have launched Uni Scholars, on an average, every second student in Uni Scholars actually is buying more than one product. And every third or fourth student is actually buying all three products and services from us. So it's very encouraging. The cross sales is doing wonders for us, and that's the whole point. What we saw in the market as a miss is it was highly fragmented market. The counselors were focusing on counseling for the student. Financiers were only looking at financing the courses. And accommodation was totally different subject matter. When we look at a student, we look at student end to end. We look at student as a single consumer, and we have created this product offering to the student so that student doesn't need to go out of ecosystem to buy any of the other services. In fact, just to extend this logic, we also help student in settling down once they have landed in the destination country. In fact, it starts a level before. We also help them in securing visas, opening their bank account when they are in their own source country. So just to give you a context, an Indian student today has a facility to open a bank account while they are in India before they embark on this study abroad journey. So these kind of eases are built around the offering. So even though the core offerings are around counseling, financing, and accommodation, there are a lot of built peripheral services which make the whole student mobility journey far more convenient and hassle-free.
Sure, Amit, that's quite interesting, and the ability to cross-sell and more opportunity there with your existing client base as well. Many thanks for your time here on Startup Street. It was a pleasure speaking with you.
Thank you. Thanks a lot.
All right, on that note, we're going to take a short break, but don't go anywhere because up next, startup layoffs are on the rise and Simpl has cut its workforce by 25%. We find out what strategy the company is going to take going forward on the other side.
Welcome back. You're still with us on Startup Street. Now, the funding winter that has startups shivering is getting bleaker and could last a lot longer than earlier estimated. CNBC-TV18's Hormad Fatakia reports that with the chill settling in, India has not had a single new unicorn join the club in the last 6 months. Take a look.
Byju's, Simpl, Zomato, Unacademy. These are just 4 of dozens of Indian startups that have had to go in for large-scale layoffs to keep their lights burning. Access to easy money has dried up, and investors are pushing companies to put profitability over growth. A few companies have even had to shut down non-core verticals to cut costs, like Swiggy shutting down Super Daily in 5 cities, or Ola shutting down Ola Play, Ola Dash, and Ola Foods. The funding winter is not showing signs of easing up either. In the first quarter of 2023, investments into Indian startups is down 75% from a year ago. The freeze is visible across the board, from early stage funding to late stage funding, and even the funding rounds have shrunk in number. This has meant that India, which saw over 20 unicorns being created in the first 9 months of 2022, has not had a single unicorn join the ranks in the last 6 months. The turmoil in the startup ecosystem has also meant that many have had to put their grand plans for an IPO in cold storage. The list includes some marquee names like Boat, Go First, MobiKwik, VLCC, Oyo, and Mamaearth. Some have also had to resort to accepting lower or stagnant valuations in subsequent fundraising rounds. Even the startups that did manage a listing, often at eye-watering valuations, have been struggling, and as have many of their shareholders. Zomato, for instance, which kicked off the trend of new age IPOs in July 2021, has lost 50,000 crore rupees in market capitalization from the high it hit on listing day. Shares of other new age listings like Paytm, PB Fintech, Nykaa, and Delivery have also taken a beating on the bourses, a few correcting up to 60% from their IPO price. While some counters have recovered substantially from their all-time lows, they are still a long way away from their IPO price. But experts say that this kind of pain will not last forever.
I think you're going to see some down rounds. That's natural, and I think it's perfectly fine for companies to take their medicine and keep moving forward. So I'm optimistic that on the other side of this, sort of, whether it's 9 to 12 months is probably my personal guess. I think on the other side of this, you'll start seeing valuations become more normalized, and you'll also see the IPO market open when we have more stability around the interest rates as well.
They add that the funding freeze will also thaw, though there is doubt whether that earlier exuberance and the propensity to put profitability second to growth will return to what it used to be. So investors may have to wait a while for the next new age IPO that commands a staggering valuation. In Mumbai, Hormaz Fatakia.
Now, after laying off almost 25% of its workforce of 150 people, BNPL startup Simpl founder Nitya Sharma tells CNBC-TV18 it was a hard decision letting go of those 150 people because the company had overestimated growth prospects. In a chat with CNBC-TV18's Aishwarya Anand, he spoke about the reason for the layoffs, the path to profitability, plans to join ONDC, and a lot more. Here's a slice of that exclusive chat.
You've actually, Simpl has joined the growing list of startups that has laid off its employees, and from what we can understand, you've let go of close to 150 employees. I hope that number is correct. So I want to understand from you what was the reason behind it, and can we expect more layoffs this year going forward?
Yeah, we, as you said, unfortunately, I had to take a very hard decision to say goodbye to so many talented people who worked with us, helped us get to where we are now. One thing that we realized as we were planning for the next year was that what we expected will happen in e-commerce in the short term, which is the growth of e-commerce in the next year or two, was definitely an optimistic assessment we had when we were planning for growth the next couple of years. As we stood, this year, we felt that we needed to operationally become a lot more efficient, so that we are able to focus on the most important customer priorities. One of the things in e-commerce is there's just so much to do, so much room to cover, and the macroeconomic environment last year was very different, and sort of allowed us to think that we should probably hire a lot more people and work on many things parallelly. What we realized as we were thinking about this year was what we need to do is focus a lot more on the most important customer priorities. And so what we did was a difficult decision to reduce the headcount so that we can focus a little bit more and be slightly operationally efficient.
Okay, now talking on performance, take us through how does your FY23 numbers look like? Where does your revenue stand? And are you profitable yet?
No, we are not.
You're not?
Yeah.
Okay. Could you shed some light on some of the numbers?
Yeah, there are a few numbers that we talk about. We work with about 25,000 online retailers. We have about 5.5 million active users. Our revenues are, in mid double digits, $1 million per annum. We are not looking at profitability in the next couple of years, but our business is such that we have a lot of levers that if we want, in 2-3 years, we can be profitable. Right now, we are focusing on efficient growth. We're definitely focusing on investing in growing the customer base, merchant base, and investing in technology.
So the last you raised funds was $40 million that you raised in 2021. So how are you positioned when it comes to capital efficiency? And do you plan on raising more funds in the near future?
Yeah, our business is relatively capital efficient. We are, unlike a traditional payment company, we focus on merchants. Our customer is retailers, and what we describe ourselves as a merchant-first payment network. So that's what we do. What that enables us to do is run a very efficient business. So we do not have traditional burns that so many companies have around customer acquisition as much as traditionally that is thought of in payments. So it's a fairly efficient business. Currently, we are not planning to raise money. We are focusing on making sure that we are investing our resources very efficiently right now. We also believe this market is not a market to raise capital.
Now, could you also shed some light on some of the plans that you have in place for 2023, and are partnerships with bank also on the cards?
Yeah, so in 2023, as I said, we are making our platform more available to connect to other businesses and enablers out there. We have had multiple conversations with banks. We are talking to banks on, providing more type of solutions to customers on checkout. We are expecting to double at least the network of merchants. So as I said, we are close to 25,000 merchants right now. This should become north of 50,000 merchants by the end of this year.
What kind of impact
and with
do you
that,
think?
it is a wrap on this edition of Startup Street from Ritu and me. Goodbye and many thanks for watching.